Hey, what's going on, everybody? It is Trevino here, and we have another wonderful guest. We have Stefan from New York. How you doing, Stefan?
Yeah, hey, Aaron. Good. How are you?
Doing well, doing well. I know we've had this in the works for a little bit, so it's great to finally connect with you.
Yep, great to connect as well, and thank you for inviting me.
Yeah, of course. You know, you have a very interesting background that not many guests really have, and I'm really interested to kind of hear more about you and your background and kind of what you do in real estate. So, you know, for those of us who aren't too familiar with you, would you introduce yourself, please?
Yeah, absolutely. So I am a financial engineer by education. So I used to trade derivatives for an insurance company for about 10 years, sort of managing like a really big, like 90 billion portfolio with colleagues. So that was my job before, like a portfolio manager in finance. So what financial engineering is, just for those of your audience, those in your audience who maybe don't know, it's really the application of math and coding, sort of engineering methods to finance. So that could be in option pricing, could be, sort of things like random processes, like stochastic processes, and maybe data analysis and stuff like that. Nowadays there is, the field of data science that has some overlappings with that, with obviously broader applications. But that's what it is. So that's my prior career. But in recent years, I've been investing in multifamily, like smaller size multifamily, primarily in the New York City area. And yeah, I'm looking at other markets as well.
Yeah, absolutely. No, I'm so fascinated by, by data science, big data, and really, real estate has kind of been known to be an industry where it's a bit antiquated, where, technology hasn't really gotten into the real estate industry, and now it's really taken off.
Yeah, it's very interesting. It's very interesting. Like actually met with a few of the prop tech guys. So there is so one of them, he has like a more innovative sort of mortgage solution that got like a bigger series of funding recently this year. And so he was saying actually it's quite interesting because on one side there are some of the prop tech companies, on the other side they haven't had like too huge of sort of capturing of the market. And it's so, and there are two things. So one, it's like real estate is like a trillion, I don't know the exact notional, but a huge market in notional terms. And so like even to an investment money, from an investment management standpoint, or like other like prop tech standpoints, it's a huge potential to capture. And on the other side, real estate actually is a big data problem. So what he was saying is actually in real estate, which may appear as this kind of simple field, it's very multivariate. Like you have a house, to that house you have assigned multiple properties, and then you have a time component. You need to be tracking them historically, so it gets a lot of data points. And even in my own investment, where I would pull a relatively smaller subset, obviously not for the whole of the United States, but for markets that I'm focused on, it gets really tedious, and there is a lot of data. And doing it professionally is actually quite a challenge. So yeah, it's an interesting field. I mean, obviously there have been innovations. There are iBuyers, as we know, like with the improvements in automated valuation models. We have blockchain is making some great developments, and with some of the, I think, like Algorand, for example, the Algorand blockchain seems to be one, or maybe Avalanche, or rather seem to be like having bigger applications in real estate. So there, there are developments. Obviously, you have Zio and etc. Like marketplaces, that change the industry. So it's pretty interesting. It's pretty interesting. Mm-hmm.
Yeah, absolutely. And I'm curious as well, more so about your background. When you were growing up, did you ever, envision yourself working into real estate, or, how did you kind of make the transition to where you are now?
No, I did not. I didn't. But I mean, no, I didn't. And like my dad would say, like, why do you study financial engineering to then go and deal with houses or something, like physical assets? And the answer to that is, to be honest, yes, there is the physical aspect is like a huge challenge in real estate, and obviously you're impacting people's lives, and you're concerned about their livelihoods, and they live the, after all, that's their home, etc. And that's a, that's a legitimate, constant, ongoing challenge, but the benefits of that I have seen, okay, to as a person coming from finance, just to say, that have been really attractive to me and still are, is, in finance there is very high level of efficiency, and in real estate what you get is levered cash flow and levered inefficiencies. So your time zero inefficiency, even if you're not renovating a property, your time zero inefficiency could be there. But if you're in a very illiquid, very small market, there could be a mispricing at time zero. And I have found that I have the majority of my personal portfolio is deals that are stabilized assets that do not require major renovation, and have taken, they all have resulted in sort of infinite COVID return, where you take out your full investment, and like the typical thing that people like on bigger pockets talking on BRRR, it's not only achievable through innovation. There are various scenarios of, regulatory arbitrage, sort of units, sort of condo conversions, kind of arbitrage, simple illiquid markets where literally you buy a return thing under market and you take out your investment in 6 months without doing anything. And that happens frequently, and so forth. So yeah, and that you do on a levered basis. You take financing, 5 times or 4 times, and that's incredibly attractive. Between time zero and time one, a year from the beginning, let's say, you can lever that inefficiency and acquire a good chunk of equity that you keep building, deal after deal. You do similarly with surplus cash flow. Now, cash flow is, if you think about what cash flow actually is, I don't know if every real estate investor thinks about it like that. It's the spread of cap rates and interest rates. Now, that may seem obvious, but the fact that is the case makes for very high, I'd say, non-linearity of absolute cash flow that you can realize across deal sizes, where very small deal size, this can bring you something of the order of 8 times the relative cash flow of a bigger deal and the same absolute cash flow. So I've been like talking actually on this, how you can have a portfolio of at the very low price of the distribution, where you can have a 2.5 million portfolio, and that can be performing at the cash flow. And that's just a component of total return, admittedly, but it can be performing at the cash flow for 20 million portfolio. And the way you do this is, if at the very low end, you identify, properties that have 20 cap, and that's most people associate with ghetto areas, but it's not true, because high caps are the result of depressed prices, but depressed prices are the result of all kinds of reasons that may be higher crime rates and stuff like that, but they may also be in very safe, sort of middle of nowhere areas, that have like perfectly, well-behaved demographic, let's say, and you can, yeah. So, I can give examples to that, but yeah, a portfolio of low-priced assets at the 20 cap performs like a portfolio, 20 million portfolio at the 6 cap, and that's the reality, and that's what, like, I feel like many investment managers, I feel they don't say, because I've always heard this, oh, it's obvious I had to move to bigger and bigger deal sizes. Well, yes, in terms of appreciation, yes. In terms of collecting fees from your investors, yes. In terms of, in terms of value add, it's debatable. That's quite interesting how value add is distributed across deal sizes. But not in terms of cash flow. Like, that's just not the case. Cash flow is utterly, unattractive to me. Now, it's attractive to an investment manager because, again, like, if you're given like a bunch of capital, are you able to distribute it in all those small assets? No, but this is more of like a personal investment advice, I guess, sort of that they provide. It's understandable the challenges that somebody with a lot of capital faces, where he cannot like find like 1,000 tiny deals or something. I get why it's the way it is, but it's sort of an insight to, to property cap rates and to property cash flow or liquidity and so on and so forth. And since many people claim they're after that in real estate investment, but I mean, I don't think I wouldn't be buying $5 million outdoor assets if I wanted cash flow. I can get the same cash flow for almost 600K of assets, and I'm serious.
Yeah.
Like it's just it's just not attractive in my opinion, and that's just something. Now value add is nevertheless attractive, and I think that's most in appreciation, and I think bigger operators, they understand that, and they operate in high appreciating markets, and they perform their value add well, and all that. But that value add is maybe somewhat labor related. Well, not necessarily, but let's say it's maybe not necessarily a mispricing, more of like some kind of work involvement related. But it still could be not too difficult in some cases. So that's understandable. But these are just some points.
Sure, absolutely. And it almost sounds kind of the opposite of what you would think, right? It's kind of counterintuitive, where people kind of say, hey, I'm looking for this sort of cash flow, I'm looking for this type of deal. Whereas what you're saying is that you're looking at more of a data-driven approach and looking at it from different angles.
Yeah, I'm pretty indifferent to deal size, a sense. It could be anything from even 20K, to, let's say, for my own portfolio, saying, not for investment, can be a million, can be 20K. I don't specifically care, as long as the absolute return is still there. And sometimes the absolute return can be there for fairly cheap things, and can be the same absolute return as it's a more expensive property. And that's kind of something I keep like bringing up and kind of trying to attract people's attention, because there's always, I feel like there's this pursuit of, where you're assuming that, if you have to scale deal size. That is correct in an investment management context, but that's a different job. That's that's not apples to apples with, an investment manager, collects his fees, has his profit sharing, etc. But that's not necessarily, that's just not the same thing. That's just totally different things, in my opinion, at least. So.
Yeah, absolutely. And you brought up a great point about, not being able to compare, apples to apples, because they're two different contexts. They're different circumstances almost.
Yeah, absolutely. Like somebody who manages 50 million of assets, and he has one partner, and he has personnel and etc. He can be making not too much money. It's possible, on the back of, and who has invested at not particularly attractive cap rates and dependent. It's there is appreciation and value, so maybe that is working well, but it really varies based on how much help he got in that process. So that is a scaled business, that is understandable, but is that necessarily more profitable than doing your own deals? Generally, no, because you're just simply collecting fees. You need a big amount of assets. Maybe at that level, then it becomes comparable to doing your own thing. But the lesser assets under management, it's less profitable. There's always this kind of assumption it's something, like big, or it's not. It's not the same thing. These are not your money. It's a different thing. Like people in finance, they manage billions of assets for that to be considered big, right? That's just trying to kind of scale, sort of qualitative assessments of that. So.
Sure, absolutely.
Yeah. And, anyways.
Yeah, and in terms of you kind of looking at data, you're looking at a lot of different variables that are in play. Are you looking at any particular markets, or primary markets, secondary markets, or what more so are you looking for?
I do have I run a data analytics company called NB Analytics. So within that endeavor, I pretty much have data on every market in the US in terms of let's say about 3,000 counties. Now, for my own private investment, it's really, I just really keep looking doing my local markets, but I am exploring like kind of bigger deal sizes for appreciation in Florida and other markets. And I mean, most of, I'm sure like some of the audience as well knows the strong markets where demand is. It's obviously Florida and Texas are the big ones. That's where, most multifamily operators are. From there, it's literally the whole western half of the US, and then none of the eastern half except Florida, pretty much. And that's how it works. And it's where it's really neither Georgia and North Carolina, or no, they have like very topical high growth have experience, at least not the last cycle. It might happen in the future. But yeah, the picture of which states and cities have performed well is pretty clear, and which is west and slightly to the south with Texas and Florida, where the Northeast and Midwest are kind of flips markets, markets for flips and inefficiency and so forth, what I do, and high cash flow. And, but appreciation is in Florida. Florida has an extremely high autocorrelation. So autocorrelation, to the benefit of the audience, is how well historical price changes predict future price changes. Let's say on a 1 year time lag. Last year's price performance in Florida versus current year price performance, and it's very autocorrelated in Florida. I think it's number 2 state by sort of momentum. So it had like, based on like 35 years of data, they had like 77% autocorrelation. That's another thing that's interesting. So if somebody wants to bet on to get just appreciation, that's probably the best place. Texas is less autocorrelated, interestingly enough, even though it's an extremely booming market. It's kind of like very middle, I think like 54 or something like that. So that's something. Also, some of the well-performing markets are currently overvalued. So in my data, I think the primary value add for people out there is really having valuation metrics for different counties or states. So at the state level, some of the really well-performing markets to the west, like notably Idaho, is currently overvalued at about 25. And that's pretty much the only really sharply overvalued place. And from there, they're Nevada, Colorado. I believe Nevada is around 17, and then Colorado at maybe 14, and Texas is at 10%, like slightly overvalued. And Florida is even now in the fairly valued range, like 0 to 10%, like 9%. So that's where some of those, on the contrary, like markets in the Northeast and Midwest, they're depressed and they're even undervalued. Like some of them are dramatically undervalued. Like Illinois is about 20% undervalued. Now, the fact that it's undervalued, that doesn't mean that that's predictive of high growth. That's not at all the case. But some undervalued markets could experience high growth. That was the case for Texas in 2007. Texas was 5% undervalued. It did not drop post 2007 because, and something I can talk to and I'll explain, in real estate, specifically in real estate, states that are undervalued, they don't drop. Like if the biggest crash happens like 2007, they dropped an average of 4%, which was the income drop at the time. And was a really interesting finding I had like back then at the beginning of COVID when I did this study, because it was really, like I always thought, okay, it's like a systemic crash, a lot of the markets experienced difficulty. It wasn't the case. It was really the markets that were sharply overvalued, which were California, Florida, Nevada, and Arizona were the big four. And their valuations were super in line with how much they dropped. It was like 40 to 60% roughly overvalued, and then 40 to 60% actual price drop. And, not the exact numbers, of course, the exact same numbers, but that was very interesting. But undervalued markets back then, like Texas was undervalued, dropped only 4%. Then, as we know, Texas has been the booming, the big state that's getting bigger and bigger, and that's really well performing. So those are like some interesting findings. I kind of urge investment managers to use to avail themselves of valuation metrics. They can do it themselves. So so the easiest way is they can use deviation from historical price to income ratios. That seems to be very predictive. There are things that aren't predictive. For example, volatility is not predictive, and or even like risk-adjusted returns are not predictive of which markets are going to drop, or population trying based on population trends to predict is not predictive. So if you take Nevada's population in 2000, post 2007, it kept booming. It was like a decade where Nevada, the state of Nevada's population was growing and growing and growing. That did not prevent them to drop 56% after the after the crash, because they were that much overvalued, and they were like super, like 60% or whatever overvalued. So it's a price to income ratio is the easiest way that anybody can implement themselves. They can also reach to me if they need help. I offer like some free reports for that as well. But it's that's the easiest way. From there, if you work on an enhancement, so at my company, basically we've been, I've been developing myself an enhancement that, that reflects like housing shortage and sort of population to housing supply ratios, and trying to build maybe, that's actually, that part is still pending, sort of a more like machine learning predictive regression that, is like better, even better. It raises even more the predictiveness. And but it's simply by using price income ratio, that's going to be good enough. Like by price income ratios at the beginning of COVID, the study that they did, 2007 price drops at the state level were predicted 83%, with 83% correlation by deviation from historical price to income. That's like crazy. It's basically you knew what the drops that are going to happen, roughly where they're going to happen, with approximate magnitudes ahead of time. And those drops, they took about 4 years to happen. So that's like from 2007 to 2011, it varied. So maybe 2 to 6 years or etc. But let's say on average 4 years. And that's but this kind of bleeding little by little over 4 years was super fundamental. And it was so aligned with it in every market. Let's say in every state, the peak happens at a different date. From this exact date, there is a, to the bottom, there is a certain time period that is a different period. And this whole dynamic, or the aggregate of this dynamic, was predicted by simply deviation from pricing ratio, which is crazy. It's so easy to predict real estate. So
Yeah, it is.
It's just like, just some some information, and because I've heard like I just feel like there's a lot of value in this, because there's so many people like I've met with, like syndicators and investment managers, and they keep saying, or some of them who are investing, back then as well, who are for longer in the real estate industry. So they would say, oh, we lost so much money afterwards, nobody could have said. That's not true, that nobody could have said. There were people who simply were following their price to income ratios. One guy was Ingo Windsor at the time. He was on CNN in 2005, 2006, talking about it. He was saying that certain markets in California, Florida, etc., are dangerously overvalued. And it was you don't know the timing, because they can stay overvalued, they can stay whichever period. This is not fortune telling. You just know that whenever the cycle, the peak in cycle gets reached, that's going to be the your best predictor of the magnitude of the downturn. And you could also, if it's not the best predictor, you can then work out a better one. But there is predictability to it. And it's because real estate is really not that complicated. It's very fundamental. It's not technology stocks where valuations would be utterly useless. In real estate, it's super simple. It's just driven by incomes, and roughly that's it. And some population to housing, like some housing shortage and stuff like that.
Sure, absolutely. And what you'd also mentioned was kind of the overvaluing, right? Which is a big concern for a lot of people, whether you're a buyer, whether you're an investor, whatever it may be. You even just using Idaho as an example, being 25% overvalued, that can be very scary for someone who's potentially concerned about there being a crash, right?
Yes, yeah, and that you're absolutely correct. You're absolutely correct, and that was exactly my motivation, because even I was concerned, at the beginning of COVID. Okay, what if markets that I'm invested in take a downturn? And yeah, I mean, Idaho is a state, and like if we take Boise, because Boise is even more overvalued. It's a city. It's actually the most overvalued city in America right now. But if we take Boise, it's because it has performed extremely well. There is super high investor appetite, and at some point it has gone apparently too much, or whatever. So I'm not saying it's not going to perform well. I'm actually quite the opposite in my sort of sentiment. Like, I think those markets that are overvalued, they would continue performing super well. It's just that at some point, once the peak gets reached, that's just sort of a downside risk measure. It's not a measure of, if a market is overvalued, that's not a good market, or in the next 2-3 years, chances are it's going to be momentum that's going to be driving it. Well, not everywhere. If you're in Alaska, it's not momentum, because in Alaska there is actually negative momentum, by the way, which is the only place. So like, good price performance in the past is predicting the opposite. So that's uncommon. But in other, like if you're in Florida, or even if you're in Massachusetts, it's very trend driven. So if a market is overvalued, I would say the best predictor of if people want to be comfortable about like price appreciation, or bet on price appreciation, they should look at, I think just the momentum measures, and that's sort of the easiest way, to try to predict that, unless they have like some, machine learning or something behind it, that is doing even more work. But in a simple sense, they can achieve it this way. So that's useful. But again, once the peak gets reached, Idaho is going to be more affected than an undervalued state that's just not going to. And I think, to me, the biggest value is really, there's so many people who are sitting in the Northeast, and they keep talking like prices are so high, and it's like such a competitive market, and the market is going to take a downturn. Or even like today, like I'm reading an article, we are in an asset bubble because of like their low returns on their low interest rates, and we're in an asset bubble and so forth, which, I mean, I'm sure that might be entering. But first, in the stock market, it's hard to determine an asset bubble, because the stock market is highly driven by tech. How do you even, I do not know if it's overvalued. I even listened to a Warren Buffett interview like a couple of weeks ago, who is, maybe considered a dinosaur, but let's say, but even him, he was saying that, he did not definitively claim or know if it's actually overvalued, because it's hard to value anything, because it's just tech stuff. But again, so the stock market is hard to say now. Real estate is very easy to say, and that's exactly why I'm having this whole conversation. In real estate in some foreign countries, so the similar study that I do was done by an economist called Niraj Shah, and it was published in Visual Capitalist in 2019. And so he showed, I don't have data for foreign countries, but he showed Canada, and Scandinavia, and Australia, New Zealand, very, very overvalued. So that just from knowing that I have dealt with this data in the US, and he has some of the similar metrics, and that just seems very definitive there. Then there's UK that is somewhat overvalued, and I don't know how it has changed after 2019. It could move up and down as well sometimes. So definitely, yeah, one can say real estate, globally, there are certain markets in Asia that are overvalued. From like other economists, let's say, studies that I have seen, I think like even Cambodia and stuff like that, you can have like real estate in specific places, but again, not in the US. So I don't know, like I keep reading these articles, like, like I said, even today, okay, there's an asset bubble, and such a broad statement. I mean, it's not true in real estate. It's going to be really interesting to see with inflation now, if it does become the case, because it can become from fairly valued, it can become overvalued in a matter of 2 years. That's what happened in the period 2003 to 2005. So actually, real estate was, especially 2002, was super fairly valued. It's like 0%, 0%. And then maybe 2003, they don't have the exact number, maybe 10%, you know? And then by 2005, some of the, some of the states had gone to like 40 and 50%. So in only 2 years. So that's going to be very interesting to see. Now, to me, there is nothing particularly concerning. And I mean, I think like also other economists like, no, it's a great time for real estate now. I mean, I'm not an economist, but I mean, economists know, that it's a great time for real estate, or physical assets, but also in other measures like cap rate to interest rate spread, for example, right? That's been very healthy and so forth. So so it's not there's no like a bubble in real estate that's just not there. There are 8 states out of 50 that are more than 10% overvalued. I mean, that's not a bubble. It's not. Yeah, sure, you have Idaho. It's a small state. Okay, there's one. But so just saying, like, it's good to have your measures. They keep changing. It's good to have the full history. Like, that's like kind of like my advice, at least, like to people, because you can be doing like some of these studies yourself. You can have the full history, kind of quarterly, and then look at it. And like, and that's what I do now. I'm gonna keep looking at these metrics. At some point, if it becomes overvalued, then it's not gonna happen to the Northeast, because the Northeast is depressed. That's not that's not how it works. But it's if I start investing in Florida, for example, I'm going to be very attentively watching every quarter pretty much what happens, because it can change. It can change pretty quickly. And there are people like I was at this like I had a conversation with someone who was saying that age of housing age of housing in the US could be a predictor of like some big crisis to happen, because like there's this really old housing, keeps getting older and older. And first, age of housing is public data that can be obtained, I believe, through even, I believe, Census Bureau, or I'm not 100% positive. And so I have looked at housing supply trying to predict downturns. It's not particularly predictive on its own. I doubt that age of the housing supply would be predictive. But and on the contrary, like it's these kind of concerns where, let's say, housing is really old, specifically in like Northeast is one example. That doesn't drive downturns. Yeah, it might suck. It's not great, and it's going to take a lot of sort of maintenance work and etc. To keep up. But it's not predictive of downturns, because those markets are underwater. That's what people, I feel like they're missing. They kind of don't have this just don't have these data points. And undervalued markets, statistically, they don't drop. Right? They're going to drop with income. They're going to drop 4%, and that's just what's going to happen. So like the state of North Dakota in 2007, that's the biggest, obviously price post 2007, that's the biggest crash in US recorded real estate price history. State of North Dakota dropped 0% in FHFA data. 0%. Why it dropped 0%? Because it was, I think it was about 15% undervalued. There is no way it can drop. Like, this is not, these are not penny stocks or something. This is like, it's like people's homes, and it's just, yeah, it's a very fundamental dynamic. And people keep saying, like, there's like sometimes people who say something is going to change. No, we're living in a different time. You shouldn't be looking at the history. Well, yeah, sure. I mean, how not forward was it in 2007, when there was all the financial innovation, like mortgage-backed security stuff and like excessive lending and etc. But that in this exact wacky kind of environment, like excessive environment, that was the predictors of that the predictor was still price to income. So again, because that's a remainder term. Like, if you have any strange reasons or like new sort of reasons to create a bubble, that's not your fundamental component. They're gonna be in your remainder term, and that's kind of what you're trying to determine. You don't need to perfectly attribute that remainder. You're just, okay, that's that's the excess. That's the excess. And yeah.
Yeah, no, it really is so interesting. And, I'm just really interested in seeing, where this market's going to turn out, whether there will
Yeah.
be a crash or, how long I guess this will last. And there's so many different
Mhm.
questions. And I really wish we could, go further on this, but just
Mhm.
really with
Yep.
time constraints.
Mhm.
Um,
Yep. Yep. Yep.
Stefan, maybe someone's listening, maybe they're in your market, or maybe they have questions about data analytics. We didn't even
Mhm.
get to talk about blockchain. We'll have to save that for the next one, right? But
Yeah, I've been learning more about it recently. I'm not an expert, to be honest, on blockchain. I know a couple of people who are relatively experts on that. I'm very interested. It's a great field. It's very beginning stages currently still, but it's really nice.
right now, I'm definitely interested to see, where how that's going to affect the real estate industry. I think it'll be really fascinating to see. But
I
maybe someone's
agree.
listening and they want to get in touch with you. Where can we find you?
Yeah, so they can go to, so my website is nvanalytics.com, so ENVVY with a double V. And so NV Analytics, and they can get a sample report of some of what we spoke about today. It's free, so they can look at like some of the, get at least a high level picture of what's overvalued and so forth. From there, they can find me on LinkedIn, Stefan Tsvetkov on LinkedIn, and I also have a YouTube channel. It's my name, Stefan Tsvetkov dash Finance Meets Real Estate. We run weekly live webinars. So we have lectures every Tuesday. We have a live audience. So you're welcome.
Yes, sir. Thank you so much. It's been great, hearing a bit about, your background, the data analytics, and really just a fascinating perspective on kind of, the state of our industry right now and potentially what the future can hold, the different markets. So it's been a pleasure and thank you for coming on the show.
Thanks, Aaron. Appreciate it.